So, have you ever wondered how some people manage to pull in a steady stream of money from real estate without, actually buying a house? No dealing with angry tenants? No dropping hundreds of thousands of dollars just to get started? Well, welcome to today's Explainer, where we're going to dive right into the source material and figure that out. Today, I'm stepping in as your personal wealth coach to really demystify how you can build real passive wealth. We're completely throwing out the traditional barriers and looking at a modernized playbook. Right off the bat, you're probably asking, how do you actually make money from real estate without buying physical property? Well, just imagine this for a second. You're sleeping, maybe you're traveling, or you're just out living your normal everyday life, and money just keeps quietly flowing into your account from real estate investments. Now, I know that sounds almost impossible, right? Kind of like one of those late-night infomercial promises, but that's exactly what thousands of smart, everyday investors are doing right now. They've found a way to bridge the gap between wanting real estate cash flow and the reality of their bank accounts, completely bypassing the traditional property market. To really get this, imagine two totally different paths to building wealth. On one hand, you have traditional real estate. You know the drill. Massive down payments, a mortgage that keeps you up at 3 a.m., endless legal paperwork, unexpected repairs, and, oh yeah, the absolute joy of unclogging a tenant's toilet on a holiday weekend. Now, on the other hand, you open an app on your phone, you buy a real estate ETF in a matter of seconds, and you instantly get exposure to real estate nationwide. No physical management, no leaky roofs, just instant access to the property market. It's a total game changer. Okay, so what exactly is under the hood here? Let's strip away the financial jargon. ETF stands for Exchange Traded Fund. In the absolute simplest terms, it's just a basket of investments that trades on the stock market exactly like a regular stock. Now, a real estate ETF specifically invests in companies connected to real estate, which are often called REITs, or real estate investment trusts. These REITs are the companies that actually own the income-producing properties. They collect the rent from their tenants, and then, here's the best part, they distribute a huge chunk of that rental income right back to investors through dividends. So when you buy this ETF, you're indirectly investing in hundreds of properties all at once. The absolute crucial advantage here is diversification. Think about it. If you own just one traditional physical apartment and your tenant moves out, your income literally drops to zero overnight. But a real estate ETF spreads your investment across this vast ecosystem. You're getting slices of warehouses, data centers, apartment buildings, hotels, shopping malls, the whole shebang. You aren't relying on a single tenant or one single building for your income. You're spreading your risk across dozens, maybe even hundreds of properties, which makes your cash flow so much more resilient. And honestly, that brings us to where the market is actually heading right now. We're seeing this massive shift in demand driven by modern technology. While traditional physical spaces like retail and shopping centers are definitely still around, the rapid, explosive growth is really in digital infrastructure. Why? Because the world is just getting more digital every single year. E-commerce giants like Amazon need these massive warehouses to ship goods. AI companies and cloud computing businesses desperately need data centers to store their information. Modern tech is quietly but massively increasing the demand for these specific sectors, and through ETFs, you get to own the very infrastructure powering the digital age. It really all comes down to this core principle. Wealthy people focus on buying assets that generate income. Look, most people spend their entire lives working for money, constantly trading their time for a paycheck. But a profound mindset shift happens when you change that equation. Instead of just working harder, wealthy individuals focus on acquiring assets that will continue to pay them over time, regardless of whether they actually clock into work that day. Real estate ETFs are designed exactly for this. They are income-generating assets that just keep working for you. Let's ground this in some actual math so you can see how this cash-flowing asset works in practice. Let's say you take $10,000 and invest it into a quality real estate ETF with a 5% annual dividend yield. That initial investment could potentially generate around $500 per year in purely passive dividend income. Now, I know exactly what you might be thinking. You're saying, Coach, $500 a year isn't going to let me quit my job and move to a private island. And hey, you are absolutely right. But the secret to wealth isn't about the starting amount. It's about the system. Because this is where the magic really happens. We take that initial $10,000, but then we apply this secret ingredient, consistency. Imagine investing an additional $500 every single month into quality real estate ETFs for the next 10 to 15 years and continuously reinvesting those dividends. At first, the growth feels slow, maybe almost invisible. But as you stick with it, compounding starts doing the heavy lifting. Over those 10 to 15 years, those consistent monthly contributions completely transform this simple setup into a serious, powerful passive income machine. So how are you actually getting richer through this whole process? It basically breaks down into two distinct steps. Step one is dividend income. This is the cash flow, the portion of the rent collected by the REITs that gets deposited directly into your account on a monthly or quarterly basis. Step 2 is capital appreciation. This means the ETF itself, the actual share price of your basket of properties, increases in value over time as real estate values generally go up. As an investor, you aren't just getting the cash flow, you're potentially benefiting from both the steady income and the long-term growth of the underlying properties. It's a fantastic 1-2 punch. Now, as your coach, I have to step in and warn you about a really common trap that beginners fall into. A lot of people just chase the absolute highest dividend yields they can find. But smart investing is about evaluating true quality, not just chasing hype. When you're looking at an ETF, you need to ask yourself some questions. What companies are actually inside this basket? How has the ETF performed over the long term, not just this past month? What is the expense ratio? Meaning, what are the fees that are eating into your profits? And crucially, is that dividend yield actually sustainable, or is it a giant red flag? You absolutely must prioritize quality over flashy, unrealistic payouts. And that naturally brings us to some tough coaching love. Because here's the hard truth. Real estate ETFs are not some risk-free, get-rich-quick scheme. They are deeply tied to the real economy. When interest rates rise, the real estate sector often struggles. Borrowing money becomes a lot more expensive for these companies, property markets generally slow down, and consequently, the price of your ETF shares can drop. It is absolutely vital to understand that market dips and economic shifts will directly affect property investments. You cannot enter this space expecting a smooth, straight line straight to the top. But listen, how you react to those dips is exactly what separates the average person from the wealthy. When volatility hits, most people panic. They let fear take the wheel and they sell their assets at a loss. But wealthy long-term investors do the exact opposite. They lean in. They view these downturns and market crashes not as a reason to panic, but as incredible opportunities to buy more shares at lower discounted prices. It's like a real estate clearance sale. History has proven time and time again that patient investors who can overcome the fear of volatility are the ones who get rewarded over time. And what's truly amazing about all of this is just how accessible the strategy has become. Years ago, real estate investing really was just a rich person's game. You needed massive amounts of capital just to get a seat at the table, but today, you can start this entire wealth-building journey right from your smartphone with as little as $50. This incredible accessibility is exactly why so many younger and newer investors are jumping into passive income investing. The traditional barriers to entry have been completely smashed. You don't need to be a millionaire to start owning a piece of the real estate economy. To pull all of this together, we really have to cement the long-term wealth mindset. True financial freedom is not built overnight. It requires immense patience to let compounding do its work. It demands consistency, like those steady $500 monthly contributions we talked about earlier. Most importantly, it relies on a fundamental shift towards the ownership of income-producing assets, rather than chasing overnight riches or the next viral stock trend. By combining quality ETFs with this patient, consistent mindset, you are literally laying the bricks for early and lasting financial independence. As we wrap up our explainer of the source material today, I want to leave you with one final provocative question to really think about. If your money actually started working for you every single month, passively generating cash flow in the background, how different would your life look? Seriously, 10 years from now, could that cash flow cover your groceries, your rent, maybe your entire lifestyle? Financial freedom is all about building systems where your money works significantly harder than you do. Thank you so much for joining me to break this down today. Keep learning, keep investing consistently, and I'll catch you next time.